Open any finance app and you'll find two camps at war. One side argues that physical property is the only proven way to build wealth. The other insists that the math of broad index funds is the only thing that actually matters. To test these claims, we have to level the playing field. Meet Jake and Marcus. They're the same age, living in the same city, and earning the same $55,000 salary. Both have managed to save exactly $50,000 to start their journey. Jake uses his $50,000 as a 20% down payment on a $250,000 rental property. He takes out a 30-year mortgage at 7% interest. Marcus takes his $50,000 and drops it into a total stock market index fund. He sets an automatic contribution of $300 a month and doesn't look at it again. On day one, Jake is winning the social game. He has a physical asset he can drive past and a tenant who pays him every month. He has a tangible story to share at dinner parties. Marcus has nothing to show for his choice except a confirmation email. There are no keys in his pocket and no asset he can point to from his car window. To his friends, it looks like nothing is happening. Over a 20-year horizon, these two paths look surprisingly similar on a balance sheet. Both men end up with a net worth somewhere between $400,000 and $500,000. But the total dollar amount is a trap. The true difference is the cost of reaching that finish line, measured in unpaid hours, debt-induced stress, and the loss of personal freedom. Jake starts with napkin math. He collects $1,800 in rent and pays a $1,330 mortgage. On paper, that's $470 a month profit. But that's quickly eroded. Property taxes cost $3,000 a year and insurance adds $1,500. Then there's routine maintenance, a $200 faucet today or a burst pipe tomorrow. But the real killers are capital expenditures. Roofs and HVAC systems expire, requiring chunks of $5,000 to $15,000 that you cannot postpone. Vacancy adds another layer of risk. 1 month without a tenant means Jake pays the full mortgage out of his own pocket, while also paying for cleaning and relisting fees. If Jake hires a manager to handle these headaches, he loses 10% of his rent immediately. For a single property, that usually erases whatever cash flow was left. To keep the math working, Jake manages the property himself. This turns his investment into a part-time job, taking emergency calls at 10 p.m. and coordinating repairs on his lunch break. Then there is the risk of a bad tenant. A person who stops paying rent but knows how to exploit the eviction process can cost you half a year of income, plus legal fees. Real estate cash flow is often an illusion that masks an active job. Jake's actual net yield is closer to 3 or 5%. His real wealth is coming from the appreciation of the house, not the rent check. Marcus's path requires zero labor, but for the first 5 years, it feels incredibly slow. While Jake is talking about his property, Marcus is just watching a number on a screen move in small increments. He relies on 3 simple variables: his $50,000 start, his $300 monthly additions, and a historical 10% market return. This is how compounding works. The growth is boring for the first decade, but eventually the gains on his gains generate more new wealth every year than his actual contributions. The trade-off is that Marcus has no leverage. He only controls the capital he actually owns, unlike Jake, who used the bank's money to control a much larger asset. He also has no monthly check to spend. Total market dividends usually yield less than 2%, not nearly enough to replace a salary. To get the zero labor benefit, Marcus has to accept volatility. He has no control over the market's direction and must endure periods where his net worth vanishes in weeks. In 2008, the stock market dropped 37%, and in March 2020, it fell 34% in a single month. Watching a $150,000 portfolio drop to $95,000 in days is gut-wrenching. There's no physical house to lean on, just a falling number. This creates a massive behavioral risk. Most people panic sell during these crashes, turning a temporary drop into a permanent loss. Marcus doesn't have to fix toilets, but he has to have extreme emotional discipline. His wealth depends entirely on his ability to do nothing when he is terrified. After 20 years, both men arrive at a net worth of roughly $500,000. On paper, it looks like a tie, but their lives were completely different. Jake worked for his wealth through labor and debt. Marcus waited for his through emotional endurance and liquid markets. Choosing isn't about better math, it's about constraints. Top right, you have time, want high leverage, and need tax shields. Real estate is your vehicle. Bottom left, you're a time-poor professional needing absolute liquidity, maximum diversification, and zero interruptions. Index funds are the choice. The passive route also scales without friction. If Marcus adds just $200 to his monthly contribution, his 20-year portfolio jumps by over $100,000, all without adding a single minute to his workload. For Jake to see that same jump, he would need to buy a second property, manage another tenant, and take on twice as much debt and labor. The real trap isn't one asset class or the other. It's choosing a path based on a headline without first calculating the 20-year cost to your time, your sanity, and your risk tolerance.